So what is that we are dealing now is financial statements of sole trading businesses, or financial statements of trading businesses, or financial statements of non-manufacturing entities. So who are these non-manufacturing entities? They will not process any raw material. They will buy the product and they will sell the product either in as is condition, or they may do some cosmetic packing on the top and they may sell that, but they will not process the product. Simple. They are traders. They buy and they sell. They don't process anything. Okay, so we are dealing with those final accounts here. So first adjustment, usually you will be given what will be the question model is, the question will have a trial balance in that, and to that trial balance they will ask you to make some adjustment. 5 to 6 adjustments will be given and you will be doing those adjustments. Okay, so what are those adjustments? All possible adjustments whatever are there in your foundation syllabus are covered here. Only thing that you have to do is just focus on this. The soft copy will be shared to you if required. Okay, but I don't think it's required. Now, what is the first adjustment that you will usually have is your closing stock. Okay, what are the variations that you will have in your closing stock here? Now, do you see a trial? I think we have discussed this yesterday for something, a trial balance chapter, I guess. How, how many accounts do you see in your trial balance here? Two accounts are there. What are the accounts there? One is your opening inventory and the other one is purchases. And in your adjustments, they gave you something in your adjustments. What is the adjustment that is given? Closing inventory as on 31st March 2026 was valued as 1 lakh. So what is the regular thing that we'll do is we'll pass a adjustment entry. Usually you don't write entries, but there will be a entry passed which will be closing stock account debit or closing inventory account debit to trading account. After passing this entry, your closing stock will enter into your trading account, credit side, and again we'll write that in the balance sheet on the asset side as the first current asset. Now what is the rule that we are following is, the basic rule is trial balance items are to be recorded once and adjustment amounts are to be recorded twice there. So following the basic rule, all the what do we call as trial balance items. Where did we write this trial balance items? Opening inventory is going into your trading account debit side as to opening stock 50,000, and the purchase of 7 lakhs is going into your purchase account on the debit side, and closing stock goes on to the credit side, right? Next, what is the second alternative modification that they may do in the problem is closing stock will be given inside. I think yesterday while doing a trial balance chapter we have discussed it already. When closing stock will get into your trial balances, if the closing stock information is sent to you before preparation of trial balance. Look at the entry. What is the entry that is recorded as, before trial balance I got to know the information of closing stock. So I will write the entry as closing stock account debit to purchases account 1 lakh and 1 lakh, and when I adjust this, what will happen is your trial balance will now get closing stock inside your trial balance there. So closing stock if it is adjusted after trial balance, and closing stock if it is adjusted before extraction of trial balance. So what is the difference that you're noticing here is, in the previous one, what is the account that you have created there? Trading account, closing inventory account debit to trading account was used. Why? Because trial balance is already prepared, and what is the next thing that you're supposed to do is prepare a trading account, P&L account, and a balance sheet there. Okay, this is the thing. Next, now look at your trading account there. What is the difference that you notice between the previous and this one is, you will not get any closing stock in your trading account. Why are we not getting any closing stock in trading account is, it is already adjusted in your purchases. What is the purchases balance that you see here? 6 lakhs. What was the purchase balance in the previous version there? Case 1, 7 lakhs. So what is the meaning of this is, either you write it on the credit side or you adjust it on the debit side. Either ways it will be one and the same. Yep. This is second version. What is third version is, adjusted purchase account is created. So what is this adjusted purchase account? It is there in the syllabus, but it will not be usually discussed. Okay. So what is this adjusted purchases account is? I don't want to show all these stock levels. I don't want to show all the stocks. That is, in your trading account, you're writing all goods everywhere. Opening stock is goods, purchases is goods, closing stock is goods. I don't write all this three accounts. I want to consolidate them into one account. Only one particular entry should be there, or only one account should appear. So what is that I will do? Instead of writing all these three in trading account, I will close them in a account called as adjusted purchases account. So what is the entry that I'm writing? Adjusted purchase account debit to close opening stock. First one is I'll close the opening stock. Usually you will write this opening stock in your trading account debit side. But now we are writing it in an account called as adjusted purchase account. One more, adjusted purchase account debit to purchases account. Usually, where do we write this purchase account? We'll write this in our trading account debit side, but I'm closing it in my adjusted purchase account. And closing stock is the asset that is created just now, and even this thing is adjusted in your what do we call this adjusted purchase account. So after writing these three entries, if I do the posting in adjusted purchase account, this is how your account will look like. And what is the pattern that you see? Don't you think it looks like trading account? It is almost identical like your trading account. Only thing is name is different. Opening stock 50,000, purchases 7 lakhs, closing stock 1 lakh. Difference 7 lakhs 50,000 minus 1 lakh, balance carried down is 6 lakhs 50,000. And your trial balance will have only one account, which is called as adjusted purchases account. Now if you observe all the three cases, the impact is the same. First case, go to your first case, trial balance, or what do we call this trading account, 50,000 plus 7 lakhs minus 1 lakh, 6 lakhs 50,000 is the debit there. Second one, we wrote only two accounts, opening stock 50,000, purchases 6 lakhs. And third one, the same story, the impact, but now it will be only one account. We'll be writing it as two adjusted purchases account, 6 lakhs 50,000. Am I being clear with this? And what is the important element that you have to keep in mind is in all the three scenarios, your closing stock will be reflecting in your balance sheet as a current asset. This is unavoidable. You wrote closing stock here. Again, in the second one, you will write it as closing stock. And again, in the third one, we are writing it as closing stock only. Adjusted purchase account is meant for trading account. Instead of showing three different figures, we are showing only one figure there. But balance sheet will always have closing stock in it. Okay, why? Because this stock is going from current year to next year for sale purpose. Am I being clear? Now, let's understand the concept and conventions that are there related to your closing stock. What are the concepts that are related to your closing stock here? First one, closing stock is recorded in your trading account based on matching concept. Now, what is matching concept? Closing stock is recorded in the financial statements based on matching concept. According to this concept, if revenue is generated in a year, the concerned revenue generating cost must be accounted for in the same year. Based on this concept, closing stock of previous year is recorded as opening stock of next year. So what is the concept here is matching concept. What is the meaning of matching is wherever you are having revenue, the concerned revenue generating cost should be there in the same year. Okay, you do one thing, like look at the thing here, focus on this. Trading accounts, two trading accounts are given to you side by side. Okay, now this closing stock is going to your next year as opening stock, right? Now, when did you purchase this closing stock? In which year was it purchased? In the previous year. But the sale, that is, you're selling this in which year? Next year. So, cost is there in one year, revenue is there in the other year. Why? Because we could not sell that stock in the current year. We are taking it to next year and we'll be selling it in the next year. So, revenue is in the current year, but the concerned stock was purchased in the previous year. And how do I match them is by writing closing stock as your what do we call this opening stock in the next year. Okay, is that clear? So cost is there in the last year. I'll write it as closing stock, and next year it will be going to the next year as opening stock. What is that I have done is I've transferred the concerned stocks cost from previous year to next year. So now when I write this, cost is here and concerned revenue is here, but the payment of this cost is made in the previous year. We are not bothered about payment, we are bothered about showing it. Where are we writing it there? Am I being clear with the concept there? So closing stock is based on a concept called as matching, and there is a convention here. What is the convention? Not important from your level, but still have a clarity about it. Closing stock is to be valued at cost or NRV, whichever is lower as per AS2 valuation of inventory. Okay, so imagine like my closing stock cost that I've got is 1 lakh, and NRV, net realizable value, or you can also call it as market value, is 80,000. So cost is 1 lakh, NRV is 80,000. What is the value that you have to write in your trading account as closing stock there? 80,000 should be taken as closing stock. Why? Always try to, conservatism says that always try to underplay the state of affairs of your business. So don't overstate it. Don't write what exactly is it. Always try to underplay. Conservatism says that. So based on this convention called as conservatism, we are writing closing stock at lower of cost or net realizable value. Am I being clear with this? Closing stock adjustment is clear. These are the only three combinations that you will get in your what we call this foundation level. You will not be getting anything more or anything less here. Right. Now, what is the second set of adjustments? Let's see the second set of adjustments here. Second set of adjustments are your adjustments related to representative personal accounts. So what are these representative personal accounts? I think we have discussed them already. These are a part of your personal accounts where we are not allowed to write the name of that particular person. We use a representative form of personal accounts there. And we have discussed there are two groups. First group is representative personal accounts related to owner, that is capital account and drawings account, and we have representative personal accounts related to expenses and incomes. We have four of them: outstanding expenses, prepaid expenses, accrued incomes, unaccrued incomes. Right now in this, look at the variations. I have put all possible combinations that you will be getting. What is the first thing that you're seeing is outstanding expenses or unpaid expenses, or expenses due but not paid, expenses due not paid during the year here. Now in your trial balance there is an account. What is the account that you see in your trial balance here? Rent account. What is the amount of rent that you have already paid? 1 lakh 10,000 is paid. Only the paid amount is appearing there in your what do we call this trial balance. Below that they gave you an adjustment. What is the adjustment here? Rent outstanding for 1 month. What is the value? 10,000. So what is the meaning of this adjustment? 10,000 outstanding rent is. How much rent was supposed to be paid for the current year? 1 lakh. How much rent was supposed to be paid for the current year? I'm not saying how much is paid. How much was supposed to be paid? 1,20,000 was supposed to be paid. But how much did you pay actually? 10,000, which means that you were supposed to pay 120, you paid only 110. 10 is still due. We call this what? Outstanding expense. And what is the accounting treatment that we will give? Before giving the accounting treatment in your final accounts, we will write a adjustment entry. What is the adjustment entry? Rent account debit to outstanding rent. So I will pass this entry in my journal proper. Then I will show the accounting effect in my profit and loss account and balance sheet. So what is the accounting effect that we are showing? To rent, from where did I take that 1,10,000? It came from trial balance. It will be recorded only once. Next, add outstanding rent. Specifically, we'll write that in our what do we call as P&L account separately, and show how much in the outer column? 1,20,000. And after this, where do I write this again? It is a liability and it will go into your balance sheet liabilities side under your current liabilities. This current is not required. It is outstanding rent. Okay. Now focus on the second one. Same example. Okay. When did you write the entry in the previous option? Did you write that before trial balance or after trial balance? We wrote the adjustment entry, rent account debit to outstanding rent after extraction of trial balance. That is why it is given in your adjustments there. Blue highlighted, rent outstanding for 1 month. It is given to you in adjustments, right? Now, if the same thing is adjusted before extraction of trial balance, that is same adjustment entry, it is passed before your trial balance is prepared. So what is the entry that we wrote? Same entry, rent account debit to outstanding rent. But when did I write it? What is the timing? Simple. Is it before trial balance or is it after trial balance? So if I write it before trial balance, already the amount is adjusted. And how many accounts do you see in your trial balance now? 2 accounts. In the previous one, how many accounts were there? Only one. Why? Because it was not adjusted while trial balance was prepared, but this is adjusted before you prepared trial balance. So rent account will be 1,20,000 and your outstanding rent account will be 10,000. Why? Already this amount is adjusted before your trial balance is prepared. Okay, what is the meaning of this is already you have paid 1,10,000. After that, before preparation of trial balance, your accountant told you that, sir, we have to pay another 10,000. And you wrote the entry in your books of accounts. With that, what will happen? Rent account will increase from 1,10,000 to 1,20,000. And on the credit side, will get outstanding rent. So now both the items are there inside your trial balance there. Am I being clear with it? Now, obviously, what is the basic rule that we are following? Trial balance items once and adjustment item twice. Do we have any adjustment here? What is the meaning of adjustment is something that has to be adjusted after preparation of trial balance. But we adjusted this before extraction of trial balance. So 2 accounts are there, and where do we write it? Rent account will go into your profit and loss account, debit side as to rent. And are we showing anything, add outstanding and all that? No, it is already adjusted. And then in the balance sheet on the liability side, we'll write as outstanding rent. Am I being clear? So these are the versions that we'll have. When did you write that entry for your outstanding rent is important? Is it before preparing trial balance or is it after preparing trial balance? So if you are writing it after trial balance, it is an adjustment entry and the amount is not adjusted in your trial balance there and account will not be there in your trial balance. The first option, do you see outstanding rent inside your trial balance? No. Why? Because it was not adjusted when you were preparing trial balance. But in the second option, you adjusted it before preparing trial balance. So your rent account is adjusted and you created a new account called as outstanding rent, which is a liability. Am I being clear with the first example? So this is about outstanding expense part. Okay, 2 versions. What is the next thing that you see? Prepaid expenses or expenses paid in advance or expense paid but not due. Trial balance. What is the expense that you see in your trial balance? Commission. Okay, man. How much of commission is paid already? They are using the word commission based on the balance. Where the balance is, you have to decide whether it is an expense or it is income. Okay. If it is an expense, it will be there on the debit side. And if it is income, you will have the amount on the credit side. Got the clarity? They don't have to tell you at foundation level, like commission received or commission paid need not be there. Okay. Now, what do you see in your adjustments here? Commission prepaid 20,000. So if 1,40,000 is already paid and in your adjustments they are saying that 20,000 is prepaid, what is the amount that you are supposed to pay as commission in the current year? Only 1,20,000, but you paid 20,000 extra. Maybe the party must have requested you and you must have paid the amount. We don't pay the amount accidentally, correct? So what is the adjustment entry that we are writing? Prepaid commission account debit to commission account. Why? My commission account, which is there in the trial balance, has got 20,000 excess there, and I have to remove that 20,000 and show it in a separate account called as prepaid commission there. So in order to do that, what is the entry that I'm writing? Prepaid commission account debit to commission account. And what is the account that you have created just now is a asset account, and you have reduced your expense account, correct? So when did we write the entry? Is it after trial balance or before trial balance? After trial balance, we call it as adjustment, and we have to show it very clearly in your financial statements. What is that we are writing in our P&L account here? To commission account 1,40,000 less prepaid. What is that we do? Outstanding we will add, prepaid we will minus. Outer column it will be 1,20,000. And balance sheet, where do I show that in balance sheet? Current assets, prepaid commission is an asset to you. Why is it an asset? It is related to the next year. It should be taken to next year. First version. Or imagine like if I have not paid this 20,000 extra, I have paid only 1,20,000. I would have got this 20,000 balance in my cash or bank, right? Or did you get it? I paid 20 extra. If I would have paid only 120, I would have got this 20,000, whatever excess payment is there, it would have been sitting in my cash account or in my bank account. Since I paid it in advance, I'm writing it as a replacement here. Am I being clear with it? Now, same example, if the same 20,000 prepaid commission is adjusted before extraction of trial balance, that is, you didn't prepare your trial balance and suddenly you recollected that we paid 1,40,000 as commission, but we were supposed to pay only 120 as commission, and you have passed the entry. What is the first thing that you have done? 2026 March 31st, prepaid commission account debit to commission. Entry will be the same, but the timing is different. So once I write this entry and prepare a trial balance, first account, commission account, look at the amount of your commission account. In the previous one, previous trial balance, commission was with how much amount there? 1,40,000. And after that, you adjusted it. But now, where are we adjusting it? Before trial balance itself, I have adjusted it. Commission 1,20,000 and prepaid commission of 20,000. Okay. Now, obviously, the basic rule, trial balance items will come only once. Where do I write it? Profit and loss account to commission 1,20,000, and balance sheet asset side prepaid commission 20,000. So if you observe, the timing is important and you should be clear when did they adjust it. Is it before trial balance or is it after trial balance is important. Clear? Now, let's apply the same thing. If you are clear with these two scenarios, you should be clear with what do we call as incomes also. Already you know 90% of it, but you have to adjust it carefully. Now, what is accrued income? Accrued income, or sometimes people they write it as outstanding. What is the first priority that is kept is always use it as accrued income only. Okay, being foundation students or CA level students, we use it as accrued income. Sometimes they also call it as outstanding income for ease of understanding. What is outstanding income is I was supposed to receive this money for the current year, but I have not received it for the current year. Or it is also called as income earned but not received. What is the income that you see? Is it an income or expense? I wrote it as credit specifically just to avoid confusion. But even if that credit part is removed, you have to judge whether it is income or expense based on the column in which the amount is there. So interest is recorded in which column? Debit column or credit column? Credit column. What is the interest that you have received already? Whatever is there in trial balance is interest that you have received. 2,20,000 is received. Let's go and see the adjustment. What does the adjustment say? Interest accrued or outstanding but not received 20,000. So how much interest was supposed to be received by you? 2,40,000. But out of 2,40,000, we have received only 2,20,000. Now, since the information is given to me after trial balance, I will pass a adjustment entry. What is the adjustment entry? Accrued interest account debit to interest account. Simple common sense says 240 should be received. 220 is received, I have to increase this amount from 220 to 240. So since the account is showing a credit balance, again I have to credit it with 20,000 to raise it to 2 lakhs 40,000, and I'm creating a asset account here. Which account is it? Just now you created a asset account and you have increased your income account by writing this entry. Why accrued interest is an asset? First thing is, you are supposed to receive it in the current year. You didn't receive it. Okay. And if received, I would have got this in my cash or bank, which will be there in my balance sheet asset side. Clear? See, you received 220. If you would have received all 240, you would have got that 20 extra in your cash or bank, right? Since it is not there, I'm writing it as a replacement there. Okay, so that is the reason. Now where do we show that? Look at your presentation will differ. Okay, what is the presentation? By interest account, P&L account credit side, I'll write as by interest account, inner column 2 lakhs 20,000. To that I'll be adding what do we call this 20,000. Outer column it will be 2 lakhs 40,000. Okay, and obviously balance sheet on the asset side, accrued interest. Simple. I was supposed to receive it, I didn't receive it. If received, I would have got it on my balance sheet asset side. I am writing it as a replacement there. Clear? Now same adjustment. What is this version? Where is it adjusted? Before trial balance, I wrote the same entry, accrued interest account debit to interest account. But what is the timeline is, I did that before trial balance. And when I do that, what is the change that you see in your trial balance there? Interest account is now showing an amount of 2 lakhs 40,000. Why? Just now I added accrued interest by writing that entry there. And where is this accrued interest? It will be there on the debit side, correct? Because it is a asset account, right? 20 is added on the credit side to interest. Accrued interest is shown on the debit side as 20,000. And what is the rule? Trial balance items, we don't have any adjustments because it is already adjusted before trial balance. P&L account, credit side, by interest received account 2 lakhs 40,000, and in balance sheet I'll be writing it under the current assets as accrued interest 20,000. Am I being clear with it? Right. This is your accrued income, two versions. Only these two versions will be there in your what do we call this foundation level. Is this clear? Let's see the last thing in your representative personal accounts. What is this unaccrued income? What is unaccrued income or advance income or income received but not earned? Right? Trial balance, I have a what do we call this income? What is the income? Consultancy fees. How much of consultancy fees is received by you already? 2 lakhs 20,000 is already received. And look at the adjustment. What is that they are saying in the adjustment there? Consultancy fees or unaccrued or received in advance is 40. So which means that for current year you are supposed to receive only 1,80,000. But how much did you receive? Your client has given you 40,000 extra fees. Now, is that fees related to the current year? No. This fees is related to the next year. Okay, first thing. Now, what is the adjustment entry? We have to reduce our consultancy fees. So I'll be writing it as consultancy fees received account 40,000 to unaccrued consultancy fees 40,000. When I pass this entry, I am reducing my income account. Okay, what is the first debit? It reduces your income. Why? You're having how much in your income account now? 2 lakhs 20 is there, but I should have only 1 lakh 80,000. So I have to reduce it. That's why I'm debiting my income account. And what is the, just now I created a liability account. Why is it a liability? Yes, sir. You received 40 extra, and this 40 extra is sitting in your balance sheet on the asset side in your cash or bank. So since there is a 40 extra there, in order to replace it or in order to balance it, we'll be writing a unaccrued consultancy fees on the liability side. First thing. Second point to understand. Did you provide service for this 40,000 to your client? You provided service only for 1 lakh 80,000. For 40,000, you never provided service. So when you have not provided service and you have received the money, can I treat it as income for the year? Now, when will it become income is first you complete your obligation, that is service to be provided to the client, and then you have to take it as income. So this 40,000, whatever we wrote, the service for this 40,000 will be provided by you in the next year. So we will take it to next year. That's why we are writing it in the balance sheet on the liability side. Now, what do we write it in the P&L account? By consultancy fees 2 lakhs, 20,000 less unaccrued consultancy fees of 40. Outer column we are showing it as 1 lakh 80, and we are writing this in our balance sheet. Why? Already this excess amount is there in your asset side, in your bank account or cash account, to the extent of how much? 40,000. Got the clarity? So these are your, what do we call as representative personal accounts related things. Now, so same example. Now you tell me what is the difference between the previous one and this one. Simple. Your unaccrued consultancy fees is adjusted before trial balance. We wrote the entry, the same entry, and now look at the thing. What is your consultancy fees balance that you are having? 1 lakh 80, which is related to the current year, and we have created a liability here. Or is it given on the asset side? It should be on the credit side. These things are adjusted. This thing will go on to your, what do we call this? Other side. Okay, we'll be getting a 40,000 here. Is it okay? Done. So where is it we are writing? Profit and loss account, credit side by consultancy fees 1 lakh 80,000, and where do we show this? In balance sheet on the liability side, 40,000. Clear? Right? Next up, let's see the third set of adjustments. What is this third set of adjustment? They are called as non-cash expenses. Okay, already you know some non-cash expenses, which are like, depreciation is one of the non-cash expense, or amortization is one of the non-cash expense, but we are looking at typical non-cash expenses. Okay, so what is this non-cash expense that we are talking about? Interest on capital. Who is giving interest and who is taking interest? Is business has to give interest to the owners, or all of you have started a business. You guys have invested, say, some 5 crores in this business. You are entering into an agreement with your business that business should give you 12% interest on the capital that is invested by you. Okay. Now, why business has to give you interest on capital when you will be taking profits from the business? First thing is, why are you doing business? One word agenda. What is that one word agenda? Profit. Now you're taking profits, right? Why business? Look at this example. How much capital did you invest in your business? 5 lakhs is your capital. And look at the adjustment. Interest on capital shall be charged at 12%. So this business owner who started business with a capital of 5 lakhs, he has entered into a, what do we call as, the terms and conditions are, business should give him 12% interest on capital, which comes to how much here? 60,000 rupees. Okay. And what is the concept here is, it is called as opportunity cost. You'll be learning it in your next level, which is called as your costing language, costing and management subjects. What is opportunity cost is, I am investing, what do we call this, 5 lakhs. So when you are investing 5 lakhs, if you're talking about business, business means risk. Are you sure that, by investing money that everyone will get profit in business? Is it mandatory that everyone will get profit? No, right? There will be a chance of getting losses also, right? So since I'm taking, what do we call this, investing this money and taking risk, I'm taking profit from you. So what is the reward for the risk that you're taking? Profit. Okay. So profit is the reward for your risk. And what is the reward for opportunity cost? What is the reward for opportunity cost? Is, say, instead of investing this 5 lakhs in business, if I put that in a safe fixed deposit in a bank like State Bank of India, will I have any risk of losing that money? No, right? So Are you trying to say that by investing money in this business, you have lost the opportunity of putting this money in that fixed deposit, and you are losing the interest that you will be getting from that fixed deposit? Did you get the point here? First thing, you invested this 5 lakhs in your, two options were there in front of you. One option is put this 5 lakhs in State Bank of India fixed deposit, which will give you only 6% or 7% of what we call as interest. Second option is invest that in business. So what is the option that you went with? Is you went with the second option. You invested 5 lakhs in business, which means that you have foregone or you have not utilized the other alternative of depositing it into what we call as SBI. So don't you think you are losing that interest there by not putting the money in bank's fixed deposit? So for that loss, your business should give you what we call as interest on capital, and it is called as opportunity cost. Am I being clear? So how much interest was supposed to be received or paid by the business to you? 12%, which comes to 60,000, right? Now, do you see any interest paid to you anywhere? Trial balance, how many accounts are there? Only one account is there. And what is that account? Capital account. Clear? Do you see any interest? No. So where is it given? It is given in your adjustments. So what is that we will do? Look at the entries here, careful with it. I have to create a expense account. What is the account that I've created just now? Expense. And what is that expense account is? Interest on capital account debit to capital account. I am adding it to my capital. It is a non-cash expense. Business will not give you 60,000. Like the way business is paying salaries to staff, business is paying rent to a building landlord and all that, the 60,000 will not be given by the business to the owner like cash or rent or interest. Okay, like the way you pay a interest to a bank or something. Now where is it adjusted? It will be adjusted in your capital. It will be added to your capital. So what is that I have done just now? First thing is I created an expense account, interest on capital account debit to capital account, 60,000, 60,000. And then when you are calling something as expense, what is the account that you have created just now is an expense account, and every expense account should be closed in your profit and loss account there, because it is a indirect expense. I'll write the entry as profit and loss account debit to interest on capital. So with this, what will happen? Where do we write this? Look at your final accounts. Profit and loss account, debit side, you are writing it as to interest on capital, 60,000. And look at your balance sheet. What is the capital that you have in your balance sheet is 5 lakhs. And how much interest is added to it? 60,000. What is your capital balance now? 5 lakhs 60,000. So it is a non-cash expense where business will not give any money to the owner, but business will add it to your capital there. This one, is it clear? Right. And what is the base for this particular interest on capital is? It is a costing concept which is called as opportunity cost. What is opportunity cost is, by investing money in this business, you have lost the opportunity of investing the money in a safe deposit. And since you are losing that, this business is compensating it. You may say that, sir, we are taking profit. Why are we taking profit? Because you are taking risk there. Okay, see, you started a business. Morning at 9 o'clock, you will open the doors and leave it there, go home and watch Netflix, and evening again you'll come back and close it and lock it. Will it work? Do you know any business where you just open it and it will run automatically? No. So obviously, you have to sit there, you have to put efforts, you have to convince your customer, you have to sell it to the customer. So you're taking a lot of risky activity there, right? So customer, if he gets convinced, he will buy. If he's not convinced, he will not buy. So profit is the reward for the risk, and interest on capital is the reward for the opportunity cost that you have foregone. This one, is it clear? Next one, interest on drawings there. So just like the way business is paying you interest on capital, business will also demand what we call as interest on drawings from you. Now what are drawings? If the proprietor has taken any money for his personal purpose out of business proceeds or out of your capital amount, it will be called as drawings. Trial balance. What are the accounts that you see in your trial balance there? Capital, how much capital is there? 5 lakhs. And below that we have one more account. What is that? Drawings account. How much did you draw during the year? 50,000. So now business is saying that interest on drawings shall be charged at 10%. That is, the proprietor has to pay an amount of 10% on the drawings, which comes to 5,000. Now, again, even this thing is a non-cash income for the business. Interest on capital is an expense. Interest on drawings is a income, and it will be a non-cash income. So what is the interest at the rate of 10% comes to? 5,000. Look at the entry here. So when interest on drawings is charged, what will happen to your capital? Your capital will decrease. In order to decrease the capital, I have to debit capital account, because capital account by default will show credit balance. And what is the income account that you have created just now? Interest on drawings there. What is the value? 5,000. And when you are calling it as income, obviously I have to close it in my profit and loss account, writing it as interest on drawings account debit to profit and loss account there. So in P&L account, where is that I am writing it? Interest on drawings. See, you wrote interest on capital on the debit side in P&L account in the previous one. Where did you write it? This one, right? 60,000. Similarly, here we are writing interest on drawings on the P&L account credit side, and look at the capital. How much capital do we have? 5 lakhs less drawings 50,000 less interest on drawings 5,000. What will be your final capital balance? Is 4 lakhs 45,000. So both of them are what do we call this? Non-cash expense and non-cash income. Interest on capital is a non-cash expense. Why is it a non-cash expense? It will not be paid in cash, but it will be adjusted in the capital of the owner. Okay. And what is interest on drawings? It is a non-cash income which will be adjusted by business in the capital account of the owner. It will not be received by the business. That is, owner will not pay 5,000 rupees interest to what do we call this? Business there. Am I being clear? Is it okay? You guys are getting it? Is this easy, or shall we go with the regular one, your books model and all that? Right. So how many adjustments are done? We are done with 3 classes of adjustments. Closing stock is over. Representative personal accounts, all permutation combinations are seen. And just now we have seen non-cash expense adjustments and non-cash income adjustments. Now let's see something called as hidden adjustments. Now, what is the meaning of hidden adjustment is your problem will not tell you clearly that you have to adjust some amount based on some hints which are there in the problem. You have to understand that there is a adjustment there. Okay, and these are the adjustments where most of you will make mistakes and most of you will lose marks. Why? If you don't adjust this particular thing, hidden adjustments, still your problem or the so-called balance sheet will tally, but the amount will not match with the key that is given for the valuation there. Okay, let's focus on this. From here, they're all high level adjustments. Focus on them. What is the account that you see in your what do we call this trial balance here? 14% investments. And when did you do these investments? Date 1st of April 2025. These investments are made. And what is the date on which you are preparing your trial balance now? Is on 31st March 2026. I think 1 year is over. You have done the investments on 1st April. Now you are dealing with trial balance on 31st March 2026, which means that 1 year is over. And did you receive any interest on these investments? If you would have received interest on investments, I would have got an account in my trial balance as interest received, and the amount would have been sitting on the credit side there. Do you have any interest received there? No. Now look at the adjustments here. No information about any interest on investments will be given in the adjustments. Nothing will be given. They will not talk anything about it. And so then how do I understand there is an adjustment? Is two things are to be observed. If you see a percentile in your account, first one is a percentile is given. This is clue number 1. And second one is there will be a Second thing, that is date is given. If these two things are coming in a combination, you should always expect that there is a adjustment that has to be done, which is not clearly given in the problem. Now, if I made the investments on 1st April 2025 at 14% of 2 lakhs, how much interest should I receive by now? Use calculators. It is 28,000. Already calculation, I mean the entire story is there on the board. 2 lakhs into 14% comes to 28,000. Did you receive anything called as interest? If you would have received interest there on these investments, you would have got that in your trial balance there. Is that clear? Now, since nothing is given, so what are the hints that they are giving you? A percentile is there and a date is there. These two things are giving you a hint that there is an adjustment which you have to do. So what is the adjustment here? Look at the entries. I have to write two entries. What is the first entry? I have to create a asset account. Why? Because if I would have received this 28,000, I would have got this 28,000 in my balance sheet on the asset side in my cash or bank. Am I being correct? Now, did you receive it? So I'm creating an asset. At the same time, I'm creating a income account here because this income is never received. It is accrued. So in order to create an account, I can create an account with a journal entry. And what is it I'm doing? I'm writing one journal entry where I'm creating an asset, which is accrued interest on investments. And I'm creating an income account called as interest on investments. Am I being clear? Or is it going over the top? This is the easiest way to complete your 21 adjustments which are there in your syllabus. Okay, or else we can do other thing also. We can read that from a text and do that, which will be very difficult to understand, right? Now, what is the second thing? When you are calling something as income and you are calling it as nominal account, obviously this income should be closed in your profit and loss account. So 28,000 rupees, look at your P&L account. By interest on investments, 28. I was supposed to receive this money, but I never received this money, and they are giving you a hint to calculate by giving a percentile and date there. Okay, simple. You are preparing trial balance on 31st March 2026, and when you have made investments on 1st April 2025, and you are saying that 14% was supposed to be received, did you receive anything there? No. So these are called as hidden adjustments, where how to find these hidden adjustments is two things: percentile and date. Am I being clear? Right. Where is that we are writing that in P&L account? Credits by interest on investments 28,000, and look at your balance sheet, 14% investments 2 lakhs, and outstanding interest on investments or accrued interest on investments is 28,000. Okay, simple. I didn't receive it. If I would have received it, I would have got it in my cash or bank there. Clear? Now, same adjustment is modified in a different way. What is the difference in your trial balance in the previous one and the current one? In the previous, same example, no change, but in the previous one, how many accounts were there in your trial balance? Only one account was there, 14% investments on 1st April 2025, 2 lakhs. And now you see a second account. What is the second account? Interest on investments received 20. What is that usually you guys will do? Without checking that 20,000 whether it is for full year or not, you will take that 20,000 and write it in your P&L account on the credit side as by interest on investments. But what is the twist in the story is, when they have given you a percentile and a date, you have to put the amount on calculator and check whether the amount that you have received as interest, is it for full year or not. Now, how much did you receive already as interest? 20,000. But how much are we supposed to receive? 28,000, which means that how much is outstanding? 8,000. So these are the two models in which they will give you an adjustment. Either nothing is received and you have to receive everything like 28,000, or a part of it is received and the part of it is accrued but not received. Okay. Now, what is the thing? Additional information, they will not talk anything about this, but they will be giving you a hint. What is the hint that is given? any date and percentile in your trial balance may have hidden adjustment there. So based on this, again I am writing the same entry. Accrued interest on investments. How much is accrued? Only 8,000. Why? Because already you have received 20,000. So accrued interest on investments to interest on investments account 8,000 and 8,000, and interest on investments account debit to P&L account. So I created what? I created a asset account. But this time, what is the asset account that we have created for? It is created only for 8,000. Why? Because already 20,000 is received by me and it is sitting in my balance sheet on the asset side as cash or bank, right? And what is the other thing that I've created? I added it to my income account. Okay. Now, already you are having an income account here. What is the value of the income that you are already having here? 20,000. I have to raise it by 8,000. So that's why I'm writing these two entries. And what is the presentation in your profit and loss account? By interest on investments 20. From where did we bring that 20? Trial balance. And to that add outstanding interest on investments 8,000. Outer column it will be 28,000, right? And in balance sheet 14% investments 20,000 and outstanding interest on investments is how much? Only 8,000. In the previous option it was 28,000 because nothing was received, but in this option already you have received 20. Balance 8 is the asset here. Am I being clear? Now, similarly, we may have a hidden adjustment in what do we call as your loans also. There it was investment. Now, what is the account that you see in your trial balance here? 12% SBI loan taken on 1st April 2025. And what is the date on which we are preparing the balance sheet here is 31st March 2026. Did you pay any interest to the State Bank of India? If paid, I would have got it in my trial balance as interest paid or interest paid to SBI. Correct? Did you pay anything? No. How much are we supposed to pay to this SBI? 36,000. Calculation is already there. How is it? 3 lakhs into 12 percentage. I would have got it as 36,000. Look at the additional information. No information about interest on SBI loan will be given in the adjustments. So how do I adjust this? Is any date and percentile in trial balance may have a hidden adjustment. So based on this, what is this account that I have created? Interest on SBI loan is which account? Expense account. Debit all expenses. And parallelly, did you pay anything out of this expense? So I'm creating a liability here. So I'm writing one journal entry. With that one journal entry, I'm creating an expense account and I'm creating a liability account, right? And when you are calling it as expense, okay, interest on SBI loan, where do I close this interest on SBI loan? Obviously, P&L account, debit side will write us to interest on SBI loan. And what is the value? 36,000. Done. And how do we disclose this in your profit and loss account? Is interest on SBI loan. How much am I writing? 36,000. And look at your balance sheet liability side. 12% SBI loan is 3 lakhs, and under current liabilities we'll be writing it as outstanding interest on SBI loan 36,000. And what are the parameters there? What are the two things that are to be observed? One is your percentile will be there in the account and date is given. Am I being clear? Now, same adjustment. What is the difference that you see? Read the entire thing and tell me the difference. I'm not in a hurry here, right? Same adjustment, right? Do you see anything new? Same thing, but there is a deviation. What is a deviation? Is part of interest is paid and the part of it is still outstanding there. Correct? So 33 lakh rupees is your loan. Same thing. Interest on SBI loan already paid by you is 30. Now, what is that usually we'll do? We'll take that 3 lakhs and write it in your balance sheet on the liability side, and you guys will blindly take interest on SBI loan and write it on your P&L account debit side as 30 without checking whether it is for full year or not. So how much are we supposed to pay for the full year? 36,000. But you're paid how much? Only 30,000. So another 6,000 is outstanding. And for that, I will write the entry. Again, I am adding it to my expense account. I'm not creating an expense account. I'm just adding it because already I have a expense account here. So add it to your expense account. Okay, how much are we adding? 6,000. Already I have an expense account with 30. Now I'm adding 6,000 and I'm creating a liability account to the extent of 6,000 because I have not paid that 6,000. And obviously when you're calling it as a expense, you'll be closing it in your profit and loss account on the debit side, and which we are showing it as an addition to the amount already paid. So interest on SBI loan account 30,000 taken from trial balance, add outstanding interest on SBI loan 6,000, outer column 36,000, and balance sheet we'll be writing it as 12% SBI loan 3 lakhs, and current liabilities outstanding interest on SBI loan is only 6,000. Is this clear? So this is your what we call as a hidden adjustment story, where how to find out the hidden adjustment is if you see a percentage and a date to an account, check whether the concerned related connected account like interest account or commissions, whatever you're supposed to receive, check them properly whether it is for full year or not. If you don't adjust them, your balance sheet will tally, but the problem is there will be a deviation with that amount there. Am I being clear? Okay, so this is your fourth set of what we call as adjustments. So how many are over? Closing stock is over, representative personal accounts are over, non-cash incomes and expenses are covered, and your hidden adjustments are covered, the major part. Now one more non-cash adjustment. What is that? Depreciation. And how many methods are there in this particular what we call as a depreciation thing is two methods are there: charge method and provision for depreciation method. Right, now let's see the variations here. Okay, trial balance is prepared on 31st March 2026. What is the account that you see in your trial balance here? Property, plant and equipment. That is all your tangible assets are covered in this property, plant and equipment. You can also call it as fixed assets, but we don't use the word fixed assets anywhere. There'll be property, plant and equipment. All of them are tangible assets, and only tangible assets will undergo something called as depreciation, and your intangible assets will undergo amortization. Okay, so how much depreciation should be provided? 10%, which comes to 50,000. So 5 lakhs worth of property, plant and equipment. On that we are providing 10% depreciation. And what are the adjustment entries that we are writing? First thing is I have to create a depreciation account, which is a expense account. And how is that I'm creating? Depreciation account debit to property, plant and equipment account. And where do we close this depreciation again? Where is that you're closing it? Profit and loss account. Debit side will write as depreciation. Now, are you trying to say that this 50,000 is paid to anyone? Are you paying this 50,000 to anyone? Like the way you are paying salaries to staff, rent to landlord, commission to your agents. Are you paying this depreciation to anyone? This depreciation is not paid to anyone. It is there with the business only, and it will be kept in a separate bank account so that once the asset becomes zero, they will use this money to replace that asset or to buy that asset again. Okay, so basically the idea of depreciation is to replenish the asset, that is replace the asset in future once the asset becomes zero. Am I being clear with it? Okay, depreciation is a non-cash expense there. Now, what is that we are showing it, and which method are we dealing with? Charge method. What is charge method is? In this method, asset value decreases every year based on the method that you are using. Either you will be going for diminishing balance method or it will be a straight line method. Okay. Now, where do we show that? In P&L account, profit and loss account, debit side, and in your balance sheet you will be writing it as property, plant and equipment. And how much are we deducting from this? 50,000, and outer column we are writing it as 4 lakhs 50,000. This is under charge method. Okay, now look at the second version here, depreciation charge method. But what is the version that we are looking at? Trial balance is provided before preparing trial balance, before preparing extraction of depreciation is already done. Now, what is this thing? Depreciation entry, whatever you wrote it just now, in the previous case, it was done after your trial balance, correct? In this case, when did you write the entry? After trial balance, it is given your adjustments that provide depreciation at the rate of 10%. Now, if I do the same, depreciation before trial balance, what is the entry that I am writing? Entry will be the same, no change will be there. Depreciation account debit to property, plant and equipment. After writing this entry and posting this entry, trial balance will be deviating. Previously, what was there in your trial balance? I think only one asset was there. And what was the value of the asset? 5 lakhs. Now what is the value of the asset here? 4,50,000. Why is it 4,50,000? It is already adjusted and you provided depreciation before trial balance. That's why depreciation is appearing inside your trial balance there. Okay. Now, profit and loss account debit side and balance sheet asset side. Do I have to show any additions and deletions? No. Trial balance, both the accounts are there in trial balance. I'll take them and write them in their respective accounts. Depreciation is a nominal account, P&L account debit side. Property, plant and equipment is an asset account. I'll write it on the asset side. Done. Next, depreciation provision method. What is this provision method? Depreciation provision method. What is this? Provision for depreciation is, and when do we use this provision for depreciation? Reserve. What reserve? Who said reserve, sir? Someone said, ah, yes, sir. What is reserve? Depreciation reserve. ఎక్కడ లాస్ అవ్వట్లేదు సార్, వాల్యూ తగ్గుతుంది అంతే. అదే మీరు డెప్రిసియేషన్ అంటే ఏమనుకుంటారంటే, డెప్రిసియేషన్ అంటే లాస్ అయిపోతుంది అనుకుంటారు. You don't see it as loss. Asset has given service to the business and the value of that service is your depreciation. Okay. Now, why is that should not be called as losses? Just now I told you. Are you paying this 50,000 to anyone? Now, where is the loss there? You guys are setting aside amount, right? That money, is it going out anywhere? Right. So what is this provision method is? Never use the word reserve. So let's understand this concept here. Why it should not be used as reserve is, there will be something called as P&L account, and in all of you have done partnership accounts. Have you done partnership accounts? In that you will prepare an account called as profit and loss appropriation account. Have you prepared a P&L appropriation account before? Right. Now, if you have not done, focus on this. We'll have something called as profit and loss account and profit and loss appropriation account. Two accounts will be there. After appropriation account, you will have balance sheet. Okay. Now, what is provision is, provisions are created here in P&L account. Okay. Where do we create provisions? Provision is created in P&L account. What is provision is? Anticipated losses and anticipated expenses for which amount is not clear, you create a provision. That is, you guys will write it as provision for doubtful debts. Remember? Provision for doubtful debts. You also call it as provision for bad debts. It should not be called as provision for bad debts. It should be used as provision for doubtful debts. Now, what is this provision for doubtful debts is? I have a doubt that I will get a loss because of bad debts, which are not confirmed yet, but I have a question mark in my head. That is, I have a question mark or a doubt that I will get loss. But the problem is, I'm not sure how much of amount of loss I will have. Then I will create a provision. Okay. And obviously, what will you have in your P&L account on the credit side? You will have something called as gross profit here, right? Now, after charging all the expenses, what is the left out thing called as net profit? The way gross profit is transferred from your trading account to P&L account, net profit is transferred from your P&L account to P&L appropriation account here. Okay, I will write net profit here. Okay, and what is the meaning of the word appropriation account? Is distribution. This particular profit will be distributed. If it is partnership, we'll use it for distribution purpose. And here I will create something called as reserves. What is reserve is, imagine like I've got a net profit of 5 lakhs. Out of this 5 lakhs, every year I have a habit of transferring 1 lakh to a separate account called as reserve account, and only the balance amount will be treated as profit. That is, I can take 4 lakhs from my business as profit for the current year, and I will not take that 5 lakhs. Why? Because this 1 lakh, whatever you are looking at, it is transferred to a reserve. What is reserve? Is set aside of profit for future contingencies. Example, till 2019, businesses were not that serious regarding these reserves. But in 2020 and 21, when pandemic came, businesses, they went into losses. Why? Because no one was there to buy anything, because everything was on a lockdown there. Correct? So in order to protect your business from what we call as unforeseen future contingencies, we create a reserve and keep that in a separate account. So provision is different, reserve is different. How is it different? Provision reduces my taxable profit. This is the amount on which you will pay income tax. After payment of income tax, whatever is there, from that we will create a reserve. So provision is different and reserve is different. Reserve is set aside of profit, and provision is when you know that you will get a loss but the amount is not clear, then I will create a provision. Okay, this is only for your clarity purpose here. Now what is this? Let's go back. Depreciation provision method after trial balance. Okay, now here what is the idea? Depreciation should be provided, but asset value should not decrease. What is the concept of provisioning method here? Is depreciation must be provided, but asset should not decrease in value. In the previous one, you guys have provided depreciation and you guys have reduced the value of the asset. What is the value of property, plant and equipment that you wrote in your balance sheet in the previous example? 4 lakhs 50,000. How did we get that? 4 lakh 50,000 is 5 lakhs minus 50,000. Now what is this provision method? Is property, plant and equipment same 5 lakhs, and they are saying that provision for depreciation on property, plant and equipment at the rate of 10% shall be maintained. So what is the entry that I am writing? Depreciation account debit. This account will be debited. This is common. But instead of writing, what did you write in this previous option, and what is that you are writing here? In the previous option, you wrote the entry as depreciation account debit to property, plant and equipment. But here I will not credit it to property, plant and equipment. I will write it in a separate account called as provision for depreciation. Second entry will remain the same. Second entry will not change. Second entry is the same. Profit and loss account debit to depreciation. So with this, what is that I have done? I have fulfilled both the conditions. First condition is depreciation must be provided, but depreciation should not reduce the value of your asset there. So how do we show this in our P&L account? No change. P&L account debit side to depreciation account 50,000. But look at the balance sheet there. Asset side property, plant and equipment is 5 lakhs, and liability side I'll be writing it as provision for depreciation 50,000. So every year, let us not call it as current provision because there will be a deviation there. So provision for depreciation will be recorded on your balance sheet liability side. So every year, what is that I will do? Every year I will add. Imagine like, this particular property, plant and equipment will have 10 years life, and you are providing depreciation under straight line method. So every year, what will be your depreciation? Same 50,000, no change. Imagine like salvage value is 0. So what is the depreciation? 5 lakhs minus 0. 5 lakhs divided by 10 years, 50,000. So every year I'll be adding that depreciation to this provision for depreciation, but I will not touch the asset. Example, let's do a calculation. Imagine like this asset is used for 6 years. How many years? 6 years. The 6th year balance sheet, what will be the value of your asset there? Property, plant and equipment? Same 5 lakhs, no change will be there. But on the liability side, provision for depreciation account will have a total of 3 lakh rupees. Simple. Why? For 6 years, you have been accumulating depreciation. First year 50,000. Second year again I will add 50,000, make it 1 lakh. Third year again I will add 50,000, make it 1 lakh 50,000. Now, what is the advantage of this method is you will have the information regarding the historical cost of the asset. Now, 6 years back, I bought this asset at what value? 5 lakhs, because I'm writing it under provisioning method. 5 lakhs is the cost. So I'll know the cost that I've spent 6 years ago. And your provision for depreciation will have an accumulation of what is the value there? 3 lakhs there. Okay. And every year you're producing. Now imagine like if you go back to your charge method, what will be the value here if the asset is already used for 6 years? 2 lakhs. Now look at the problem here. All of a sudden, after 6 years, property, plant and equipment, what you said is 2 lakhs. Is it? Will it be 2 lakhs? It will be 2 lakhs. Now you are selling this asset and suddenly you want to know what is the cost that I've incurred, and you forgot that you bought this machine 6 years ago. Got the clarity? So in order to have that clarity, that is everything is available there. Cost is always recorded for the asset and it will remain at cost only. Whatever depreciation that you are providing, it will be there on the liability side. If you want to know the value of the machine today, 5 lakhs minus provision for depreciation, difference is your WDV. Written down value is 2 lakhs. Now, can you do that here in this charge method? So what is practically followed is provision method is practically followed. Charge method will be followed by small businesses, okay, which will have only one asset or two assets, like Xerox shops and all that. They will follow that. But if you're having huge, what do we call as asset base, it is advised that you should follow provisioning method. Why? Cost is available, depreciation provided till now is available. Take the difference of these two, you will get the written down value of the asset that you have got. Is this clear? Next, depreciation, same provisioning method. If the depreciation is calculated before trial balance, possible, right? So what are the changes? Same entry. What is the entry that you're writing? Depreciation account debit to provision for depreciation. And what is the story here? Property, plant and equipment 5 lakhs. Depreciation will be there inside your trial balance with 50,000, and provision for depreciation will be there on the credit side with 50,000. Unlike in the previous one, did we have all these in the trial balance there? No, only one asset was there, property, plant and equipment with 5. Now you are having 3. Depreciation is there, provision for depreciation is there, property, plant and equipment, everything is there inside your trial balance. You have to just take them and write them in their respective statements there. So property, plant and equipment will go into balance sheet asset side, depreciation will go into P&L account debit side, provision for depreciation will go into your balance sheet liability side. Is this clear? Now, this is your set number. How many are over? Closing stock, representative personal accounts, non-cash expenses and incomes, hidden adjustments, and your depreciation adjustment is over. Okay. Next thing. What is the time now? Oh, 58 already. Right. Now still some more adjustments are to be done. Tomorrow we'll take care of what we called as abnormal loss of stock. In this we'll be seeing 3 cases. Case 1, case 2. This is it can be a 2-way adjustment or it can be a 3-way adjustment. Okay, so some more adjustments are there. We'll take care of this tomorrow. Okay, I mean tomorrow, today is Friday or Saturday? Monday. Okay, you do have class tomorrow. Right. If you have class, we'll do. Okay.